I live is on fire right now. Literally, the entire city of the Pacific Palisades is burning.
We're getting a first sense of the economic toll taken by these devastating Southern California wildfires. Experts at AccuWeather estimate it'll cost as much as $57 billion. Homeowners affected have unique insurance factors at play as they try to put their lives back together. Many lost their original insurance coverage in the months leading up to this disaster. More on that in a minute. These wildfires spread from unseasonably dry conditions and strong Santa Ana winds. At least 5 people are dead, while more than 100,000 people evacuated areas under threat. There are at least 5 fires covering more than 45 square miles, ravaging the region. The Pacific Palisades fire is the biggest, burning through nearly 27 square miles and destroying more than 1,000 buildings. At the time of this report, it is 0% contained and being called the most destructive in Los Angeles' history.
Houses have already burned. Others are in danger. People are having trouble getting out of the Palisades area because there's limited amounts of roads going into there, very narrow roads. And because of that, they're having trouble getting down out of the hills down into the Pacific Coast Highway.
Another fire started Wednesday evening in the Hollywood Hills. The area from Malibu to Santa Monica is some of the most expensive property in the United States. The median home value in the area is more than $2 million. Pacific Palisades sits right in the middle of the region. In the wake of the devastation, homeowners in the area will face an uphill battle to rebuild, and the cost could be spread to insurance holders throughout the state. State Farm, a major insurer in California, reportedly canceled hundreds of policies for homes in the Pacific Palisades over the summer to attempt to avoid, quote, financial failure.
Insurance is a social good. It is really good at covering a loss that you may have when a bunch of other people who have the same exposure to it don't have the loss at the same time. So an auto accident, for one person who has an auto accident, there are hundreds of people who are insured who don't have an accident at the same time. Hi, my name is Chuck Nice. I am a professor in the Risk Management and Insurance program here in the College of Business at Florida State University. I've been studying catastrophes since graduate school back in 1993, right after Hurricane Andrew hit the state of Florida. When you have these things like wildfires or hurricanes or floods, and the loss affects a large portion of the population, especially in a very small geographical area at the same time, insurance works, but it doesn't work as well. It becomes more expensive. And the losses to the insurance company, when they become what they call correlated, it makes insurance companies' cost of capital higher. It makes their losses higher. It makes them more reluctant to do a large volume of business in a specific area.
Insurers have been backing out of the area as wildfires become more frequent and destructive. But there are options for those who can't find private coverage in their communities.
Every state has some type of a residual market called a fair plan in most states that will enable you to get access to that insurance, even if the private market's not willing to provide it. It's called fair access to insurance requirements.
In California, FAIR is a syndicated fire insurance pool comprised of all insurers licensed to conduct property casualty business in California. The program uses no public or taxpayer funding.
States have a variety of different ways in which they fund their FAIR plans, and some of them just allocate those policies to insurance companies. Other ones what they'll do is they will bill the insurance companies for losses that the FAIR plan absorbs. And if that's the case, in many states, what those insurance companies do, they can pass those costs on the policyholders. They can pass through those additional losses that they're paying to the FAIR plan to their current policyholders. So even though the state's not paying for it, the citizens of that state are paying for it.
As insurers have dialed back coverage in fire-ravaged regions, the number of California FAIR policies has doubled between 2020 and 2024, reaching more than 450,000 customers. Since 2020, FAIR's insurance exposure has jumped from $153 billion to more than $450 billion. It's a 200% increase in 4 years.
What I tell people in California is you're about 20 years behind where we are in Florida. And what I mean by that is, everything that California can do today to keep those traditional insurance companies in the state is going to help. What we saw in Florida is when those larger companies decided to reduce their exposure, we needed additional insurance companies to come in to provide the coverage that was necessary. Our FAIR plan, our citizens grew substantially, and then it shrunk. And then when we had our crisis a couple of years ago, it grew substantially again. And now you'll notice, as we've stabilized our market, it's starting to shrink again.
Nice says all of this will eventually result in a secondary problem for people seeking homeowner policies.
Price, availability, affordability, these are all issues that are going to be on the docket for California probably for the next 10 or 20 years with regard to insurance.
Many celebrities live in the region and many have lost their homes. That includes reality TV star and hotel heiress Paris Hilton, who wrote on Instagram, "Sitting with my family, watching the news, and seeing our home in Malibu burn to the ground on live TV is something no one should ever have to experience. This home is where we built so many precious memories. My heart and prayers are going out to every family affected by these fires."
And it's gnarly, you guys. It's just a catastrophe in Southern California. Obviously, there have been horrific fires in many places. This is literally where I live. Everything. The market I shop in, the schools my kids go to, friends, many friends now have lost their homes. So it's a really awful situation.
Despite the fact that many homeowners in the Palisades fire have the means to recover, Nice says it's still not a good idea to go without insurance.
These are some of the wealthiest homes in the country, some of the most expensive homes in the country. They can afford it, then they should be able to afford their insurance premiums. What happens when someone just chooses not to buy insurance? What you're doing then is when a loss occurs, somebody pays for it, right? Now, it could be the homeowner if they're not insured, or it's the insurance company, right? Or it's the FAIR plan, or whoever's out there. It could be a surplus lines company. When you start deciding not to buy insurance, what you're doing is you're pushing these large-scale losses on the party that probably is the least effective party in being able to manage that loss.
And whether it's a wildfire in California or a hurricane in Florida, expensive disasters tend to drive more insurance companies out the door. For Straight Arrow News, I'm Simone Del Rosario.